Welcome, accounting boffins. You are with Ashraf Patel and the crew. Remember, we have to focus on what we are doing. So today, our lesson is on projected income statements. Right, so if we move on and we look at what we've done so far, just to give you a quick recap, remember we've done the cash budgets, and in our cash budgets, we've dealt with the receipts, we've dealt with our payments. So that was your cash budgets, dealing with actual monies that were received and actual payments that were made out. However, when we're looking at the projected income statement now, it changes the concept completely. Why? Because now we're not looking at receipts and payments any longer, but we are focusing on, watch, what is the projected income statement? The focus will be on incomes and expenses. In other words, completely different to your cash budget. Remember, there were items that were not featuring in my cash budget. Example of that would be depreciation. Why? Because it was a non-cash item. However, depreciation will definitely be a figure, or it will actually feature in my projected income statement. Why? Because it is an imputed expense. That's just one example. Now, if we look at, obviously, within the transactions, when we have all our cash sales and cash payments, credit sales and credit payments, all these figures, like your normal income statement, and the advantage of a projected income statement is that in terms of prior knowledge, you already know what an income statement looks like. Why? You've dealt with it before. But this is now what we call a projected income statement, something that we are forecasting for the future. What's the purpose of your projected income statement? Very clearly, it is used to plan and predict the amount of profit. Now, can you see the difference? And this is very important for an accounting student to take cognizance of. Your cash budget deals with the bank balance. In other words, your cash flow, cash received and cash paid out. Whereas your projected income statement deals with incomes and expenses, and we're looking at profit. That's right, the profit component. Okay. And it also looks out for the estimated income and expenses for the forecast period. So once again here you can clearly see that when your focus is on the projected income statement, your mindset has to change now from a cash budget. Now you don't think receipts and payments any longer, but now you focus on incomes and expenses. Now, obviously, like I said, we've done an income statement before. Let's go through it. In your income statement, you include all the expenses that are expected to be incurred during the budget period. So, whatever expenses that you think may occur in the budget period will definitely feature in your projected income statement, right? Then you have all the income that is expected to be earned. Watch the terminology here, people. Very important. Let's focus on that for a while. When we're talking about incomes, we're talking about incomes that we are earning, right? And therefore, you'll see the word earned. When we're talking about expenses, we're talking about expenses that will be incurred. Can you see the word we are using there? So clearly it is very, very evident to you that an amount may be an expense, but it may not be a payment. Obviously, you can think now, and this is where you link your knowledge of adjustments into your forecast income statement. Just to illustrate further by means of an example, if you have rented out premises, right, at 5,000 Rand a month, and you expect to receive for the year, so obviously 5,000 times 12 will give you an amount of 60,000. That's the income you expect to earn. However, the income that you've actually received may be a different figure. Okay? So if we break that up and we say, fine, the 60,000 Rand is the income that I have earned, whereas I look at this here and I say, if we take that amount of 50,000 and we say that's the amount that we have received, clearly you can see in your projected income statement, your rent income will feature as 60,000, the income that you have earned, whereas in your cash budget, the income that you have received from rent income will only be 50,000. So clearly you can distinguish now between what is supposed to go to the cash budget, only cash that we have received and paid obviously, whereas your projected income statement will have your incomes that you have earned and your expenses that you have incurred. When we are preparing the projected income statement, obviously management will analyze and estimate on how certain decisions will impact on profits. For example, a decrease in advertising will result in a decrease in sales. Clearly, these are management decisions. So once again, when we're preparing the projected income statement, it is done with this in mind to ensure that we make the highest possible profit for the business. So the example that we have used here is that if we decrease our sales, obviously, let me repeat that. If we decrease our advertising, what impact will it have on our sales? So clearly you can see that if you decrease your advertising as an expense, it will lead to a decrease in sales. And do we want that? Certainly not. Every business tries to maximize its sales and in such a way make the greatest possible profit. When you're analyzing the budget in terms of your forecast income statement, management can ascertain whether the business will be profitable over the budget period. So immediately, without actually experiencing the year, at the beginning of the year, management can draw up a projected income statement and say, right, based on previous experience, this is important. Once again, when we're drawing up our projected income statement, we're looking at last year as the basis, and we're working from that in order to project for the next year. So this is another important factor to take into consideration. We always look at the previous year's figures in order to project for the future. By analyzing the budget, the projected income statement, again, what are the decisions that we will be taking? We'll be looking at our projected sale figures and to see whether these sales figures are satisfactory or not. Now, once again, remember, this is a forecast. What actually happens may be something totally different, obviously, depending on various contextual figures and circumstances. So this is important to remember. Yes, you are planning in advance. You are budgeting for the next financial year. You are projecting. That's why it's called a projected income statement. However, it may not end up to be that, but definitely if you do not have this plan in place, then certainly you're going nowhere. Also, which expenses need to be reduced? Whenever we incur expenses, we've got our expenses from the previous financial year in our last year's income statement, okay? And remember, the income statement is now called the Statement of Comprehensive Income. So therefore, when they talk about an income statement or the Statement of Comprehensive Income, it's one and the same thing. So, looking at your expenses, once again, what's the idea? The idea is to reduce expenses. But once again, you can't just reduce expenses nilly-willy. Like I alluded to in the previous part of the lesson where I said, if you decrease your advertising, yes, you're decreasing your expense, but what are the implications? What are the consequences of that decision? Obviously, by decreasing your advertising, you could have a negative impact on your sales. So it's not a case of just decreasing expenses nilly-willy. Again, what will management do when they are forecasting? They will look at the enterprise and see whether we can afford to hire additional staff. That means looking at our staffing complement. Would it be possible to hire more staff? Or, on the contrary, what is the possibility that because of poor economic conditions, is it maybe that we now have to retrench staff? So understand, people, these are important decisions that are made based on, like I said, concrete evidence. And what is your concrete evidence? In this case here, your last year's financial statements. That will give you an indication of how you can project for the next year. Also, whether the business should intensify the advertising. Because of the competitiveness of markets these days, it becomes important that we advertise our business. And in this way, if we advertise our business, we can clearly see how this will influence our sales. Okay. Your projected income statement predicts a loss in a specific month. Management can make suitable arrangements to prevent this from taking place. In other words, if you're looking at a projected income statement and it is indicating that there's a possibility of a loss in that month, immediately management needs to say, okay, hold on, what actions can we take to prevent that loss from occurring? So understand what we're saying. It is just not a preparation of something that we put away in a cupboard. No, it is something that we interact with on a continuous basis to ensure that we take corrective action when necessary, to ensure that we do not sustain a loss, to ensure that we try to the best of our ability to maximize our profits. Okay, so now, if we summarize what we have done in this segment of the lesson, let's take the following into consideration. 1, you've prepared the cash budget. And in preparing your cash budget, what have you taken into consideration? You've taken into consideration all your cash receipts and all your cash payments. Okay, now, that will then give you the bank balance that you anticipate for that particular period under review. Now, this, people, impacts on your cash bank balance. The reason why I'm emphasizing this here is to draw a parallel between your cash budget and your projected income statement. Right, so the cash budget, like I've explained, takes into consideration all the cash that you've received or you anticipate to receive and all your cash payments that you anticipate to make in the budget period. So that will you'll either have a cash surplus or a cash deficit, and then you'll bring in your balance of your cash at the beginning of the month. We're just repeating what we've done in previous lessons for you. This will then give you the situation with regards to cash. Right, let's put that aside. Now we bring in the projected income statement. What is the projected income statement? Your projected income statement is a projection of future incomes and expenses. Right. So, if I just give you an example, just to illustrate this point a bit further. If I tell you we intend purchasing equipment to the value of 300,000 Rand, right? The first question I'm going to ask you, this purchase of the equipment, does it impact on my cash budget? Certainly it does. Why? Because money is going to be leaving our business. But if I asked you, will the purchase of equipment impact on my projected income statement? Then the answer is an emphatic no. Why? Because there's no impact on my profits per se. However, the fact that I'm purchasing equipment means that because equipment was purchased, there will be an item like depreciation, which will impact on my projected income statement. So yes, the purchase of the asset doesn't impact on my projected income statement. However, the depreciation on that equipment will definitely impact on my projected income statement. Why? It will appear under my expenses, and we all know the depreciation is an imputed expense. Okay, so clearly now you should have this mindset that a cash budget deals with the cash items, whereas my projected income statement deals with all incomes and expenses for the period under review. Okay, finally, another important consideration that you have to take into consideration is the fact that there are some items that will appear in my cash budget but not in my projected income statement, and vice versa. There are some items that will appear in my projected income statement that will not appear in my cash budget. Okay guys, I'm sure you need to know, you want more information on the projected income statement, so stay with us. When you come back, we'll continue with the projected income statement. Welcome back, accounting boffins, right? Remember, stay focused. Our lesson today, we're concentrating on the projected income statement. Right, so if we move on and we ask ourselves, what are the guidelines? What do we use to prepare the projected income statement? Let's go through the guidelines together. One, when you are doing a projected income statement, you must consider the following. One, what is the percentage markup on the cost price? Right? Important. Two, will there be an increase or decrease in your income? So obviously, if you intend increasing your markup, then obviously there must be a good reason to do that. Or, on the contrary, if you want to decrease your markup, then also remember what impact is it going to have on your income. In other words, in this case here, how will it affect your gross profit? Because remember, when you're calculating, just to show you your calculation, and you should remember this, your cost price, your markup, and your selling. Your cost is 100, your markup is 50, therefore your selling is 150. So we use this in order to determine what will be the percentage markup on the cost price. The next thing that you look at is, again remember, these are all considerations that we make when we are preparing the projected income statement. One, will there be an increase or a decrease in your operating expenses? Right? Again, if you're looking at your operating expenses, there's a whole lot of operating expenses that will be impacted. Obviously, the first thing that you look at would be the effect of inflation on certain expenses. You notice that you're going to have fuel hikes. The price of fuel may increase. The price for electricity will increase. Obviously, your demand from your labor, your salaries and wages will also increase, because obviously your employees must be given a living wage, and the least increase that they can expect is it should be related to inflation. So very important when you are doing these calculations to take into consideration what is the inflation rate, what percentage do you expect it to increase by, and these are the considerations that we take into account when we are preparing a projected income statement. So you also look at whether there will be an increase or a decrease in your long-term loans. Now, let me explain this one because it's important. If you are receiving a loan, right? Clearly, the money is going into your bank account. So the loan that you are receiving, that loan component affects my cash budget. Obviously, the loan that I'm receiving is seen as a receipt, and it will be part of the monies that I anticipate to receive. But in order to service that loan, I'm referring here to the interest on the loan. That interest on the loan obviously will be paid, so it will appear also in my cash budget under my payments, right? But it will definitely appear in my projected income statement, where at the bottom of my income statement, I have interest expense, right? You need to focus now, and you need to imagine the normal income statement that you normally draw up. Remember, interest income and interest expense are not operating expenses. They do not feature under your operating expenses section of your income statement, but rather they feature at the bottom of your statement of comprehensive income, where you have a specific heading for interest income and another one for interest expense. So why is that? Because interest is not an operating expense, but a financing expense. Keep that in mind, because obviously this knowledge you can use when you're drawing up a normal income statement and in other aspects of your accounting work. So once again, interest income and interest expense are not operating expenses, rather they are financing expenses. Okay. If you look at your deposits, your fixed deposits, again, what are we doing here, guys? We're looking at all the guidelines that we need to take into consideration when we are preparing the projected income statement. Okay, now let's look at this one here. Will there be an increase or a decrease in the investments, fixed deposits? And why? Well, why should it impact? Why should we worry about it? Once again, let's take an example. A fixed deposit that is maturing, right? That money is coming into, there's an inflow of funds into our coffers, right? So the bank account is increasing. Or if you're taking money out of your bank account to put into a fixed deposit, money is leaving your bank account. So clearly you can see that the increase of the fixed deposit and the decrease of the fixed deposit will definitely impact on your cash budget. But how does it impact on my projected income statement? Very clearly. Like we spoke about the loan, where we're to pay interest. When you're dealing with a fixed deposit or any other investment, then we are going to receive the interest. Okay, now I want to illustrate this with another example for you. If you take into consideration that we have earned interest on the fixed deposit of 12,000 Rand, right? We've earned 12,000 Rand. So let's put that figure here. 12,000 Rand is the amount of interest that we have earned. However, we have only received the interest on the investment of 8,000 Rand. So clearly you can see now you're sitting with two amounts dealing with the interest. One amount represents what we have received, okay? The other represents what we have earned. Now, how will this impact on my forecast budget, cash budget, and to my projected income statement? Let's look at it. The amount that you've received, that one there, is what we have received. So obviously that figure will go into my cash budget as under my receipts. Interest on investments, 8,000 Rand. That's the actual amount that we have received. When you're drawing up your projected income statement, remember what we said. We're talking about incomes that we have earned. And therefore, when you're drawing your projected income statement, right, there, what do we say? You're looking at the 12,000 Rand, which is the amount of interest that we have earned. So clearly, you can see that the difference between what we've received and what we have earned. Obviously, the cash budget deals with cash items only, whereas your projected income statement will have the total amount that you have earned. Okay, then we're looking at, will there be any purchase of a fixed assets? And I've alluded to this early on, but let's do it again. If we purchase a fixed asset to the value of 400,000 Rand, right? It was paid for, it's going to impact on my cash budget. Under my payment section, I'm going to show an outflow of cash of 400,000 Rand because we purchased equipment or any other asset for that matter. How will that impact on my projected income statement? Very clearly, the 400,000 does not impact on my projected income statement. Why? Projected income statement deals with incomes earned, expenses incurred. Yes, the fixed asset that we have purchased, that depreciation on that fixed asset will certainly impact on my projected income statement. So yes, the purchase of the asset has nothing to do with the projected income statement, but the depreciation on that fixed asset will certainly impact on my projected income statement. Once again, we're looking at items that we need to consider or guidelines when we are drawing up the projected income statement. Will there be a disposal, a sale of the fixed asset? Again, you notice that asset disposal comes in here. And again, one of the examples that will clearly give you a clear guideline as to what goes into my cash budget and what goes into my projected income statement. Let's do this example here. You've got your selling price of your asset, right? And you've got your carrying value of the asset, right? And you've got your profit or loss on the asset. So if my selling price is 10,000 Rand and my carrying value is 9,500, clearly you can see that your selling price is greater than your carrying value, indicating a profit of 500 Rand. Okay, now, in terms of what goes where, when you are drawing up your cash budget and you are told that a vehicle was disposed of, was sold for cash for 10,000 Rand, there's my selling price. Clearly you can see the 10,000 Rand will go into your cash budget, right? So this means that that figure is going into my cash budget. That's the amount of money that I'm receiving for the disposal of my asset. Okay. However, what figure will go into your projected income statement? And once again, this information is important for the projected income statement, but it's also important for a normal question on the income statement. As you can clearly see, what figure do you require for the income statement? You only need the profit or the loss on sale of asset. I repeat, for my projected income statement, the only one component that I require would be my profit on sale of asset or my loss on sale of asset. In this particular example that we have used here, you can clearly see there's a profit on sale of asset. Why? Because my selling price was greater than my carrying value. I've made a profit on sale of asset. Therefore, in my projected income statement, I'm going to show a figure of 500 Rand under my other incomes as profit on sale of asset. Please, this is very, very, very important when you take into consideration what goes where. Okay, we also said, will there be any changes with regards to my sales policy? Again, your sales policy is going to impact directly on your projected income statement, because any change in policy will either increase my sales or decrease my sales, which then obviously will impact on my profit. Remember, at all times, your selling price minus your cost price. In other words, your sales minus your cost of sales will give you your gross profit. So therefore, you can see, if there's a change in that sales component, that's going to impact on my profit. When we are working this out, and this is important, if you're working to draw up a projected income statement for 1 month, right? That's your projection for 1 month. You need to look at the figures that are given to you. So if you're given an income statement for a financial year that is drawn up for 12 months, so clearly you can't use the figures as they are. You need to reduce those 12 figures to work out what it is for 1 month. I mean, that is simple. You are given a projected income, or you are given an actual income statement from January to December, which is 12 months. But if you're projecting for 1 month only, then those figures are for 12 months. You need to divide it by 12 to determine what is it for 1 month. So, very important, what do we do here? Divide the amounts by 12. Why do we divide it by 12? To find out what is the amount for 1 month. Clear, guys? Okay. So, what we will do now, we will just summarize what we've done so far. We've shown you, or we've given you the actual guidelines for what we use when we are drawing up a projected income statement. Very important considerations. Take into account that if you are given an income statement to use as a basis for your projection, that is based on 12 months, and you have to divide by 12 to actually get the 1 month, because you're only projecting for 1 month. Okay, so you've seen we've started dealing with intricate matters with regards to the projected income statement. Take a quick break. We'll see you in a jiffy, and we'll continue with the projected income statement. Welcome back, accounting boffins, right? We're busy with the projected income statement. Let's get right into it. Okay, guys, let's look at this calculation. Our sales figure is 960,000, okay? So, if that's my sales figure, it's for the year, meaning it's an annual figure, right? So what do we remember? Take the annual figure and divide it by 12. Why? Because you want the monthly figure. So, they're telling you average monthly sales are expected to remain constant in July and August, and will only increase by 10% in September. Right, here's my workings. Watch. Take your annual sales figure, which is 960,000, divide it by 12, because we have 12 months in the year, and the figure that was given for you was an annual figure, and that gives you 80,000 as your average monthly figure. Now, you know that July and August will remain constant. That means there'll be no change for July and August. However, what happens in September? This is what happened. In September, it increased by 10%. Okay? So the first thing that you do is you take your... Right, so let's do the calculation. We know that it is 80,000, right, times your 10%, okay, and that will give you the increase of 8,000 Rand. So this is what we do now. Watch. 80,000 Rand plus the increase. We've calculated the increase as 8,000 Rand, remember, from our calculation. So obviously 80 plus the 8 will give me a final figure of 88,000 Rand. So that will be my projected sales for September. Okay, so now let's look at my answer. Again, we were told, just let's recap the question. Our annual sales were 960,000, of which there was to be an increase of 10% in September. So here we go. July stays at 80,000 Rand because it was supposed to stay the same. August stayed at 80,000 Rand. However, in September, my projected sales will be 88,000 Rand, as you've seen with the calculation that we have done. So remember, one of the secrets of a projected income statement is a calculator skill. You need to know how to use your calculator, because all that you're doing is you're calculating an increase or a decrease, and therefore it is important for you to know how to use your calculator. Okay, let's move on. Remember, we're doing examples of calculations based on the projected income statement. We are told that the rent income amounts to 38,400, right? A monthly rental charge to the tenant will be increased by 10% in August. Okay, that's the information that we have. Step number 1, take your figures, annual rental income. Once again, annual rental income tells you that you have to divide that figure by 12. Okay, now, just a quick break here from this particular question, just to give you more information. Don't always take for granted, don't always assume that it's an annual figure that's given to you. They could have said that the rental for 6 months accounted for this figure here. Then obviously it changes your calculation. Generally, it would be for the year, but don't take for granted it will always be for the year. So it's important to RTFQ, read the full question. Right, okay, so there we have it, 38,400. Here we go. Let's take our 38,400. Because it's an annual amount, we divide it by 12, giving me a figure of 3,200, right? So the average per month is your 3,200, monthly average. What do we expect to happen? We expect to increase by 10% in August. So therefore, 3,200 times my 10% will give me a figure of 320, plus the 3,200 will give me a figure of 3,520. There we go. So you're increasing it by 110%. Why? 100% plus the 10% increase, 3,520. So that will be my new rental effective from August. So if I go into my projected income statement, watch what happens here. July stays at 3,200 because there was no change anticipated in July. However, the 10% increase was to take place in the month of August. Therefore, you notice the 3,520 is applicable to August, and the 3,520 is applicable to the month of September. So once again, guys, you saw calculator, take out your calculator, work out the 10% increase from the base month that's given to you, add it to the month in which you are increasing, namely August, and therefore the change is effective from August, clearly indicating to you when you are doing your projected income statement for July, August, and September. Clearly you can see July is constant, the increase is in August and in September. Okay, next one. The firm has a mortgage of 50,000 Rand with Zondo Bank. The interest rate on this mortgage is 15% per annum. 10,000 Rand of this mortgage is repayable on the 1st of August. Once again, information pertinent to the question. Here we go. Step number 1, 50,000 Rand, which is your mortgage bond, which is your loan, in other words, times the 15% will give you, let's do that, 50,000 times my 15% will give me my figure of 7,500 divided by 12 will give me a figure of 625. Okay? So that is your 625. Now watch what happens next. There was a repayment on the loan, right? 10,000 Rand of this mortgage loan is repayable on the 1st of August. This means that you now take your capital sum of your loan minus the 10,000 Rand, giving you a figure now of 40,000 Rand. Clear? Okay, now we take the calculator out again and we say 40,000, which is the new amount of the loan, times your 15% divided by 12 will give you a figure of 500 Rand. Clearly you can see, as a result of the repayment of the loan, the interest will also decrease. This means, therefore, watch, in July, the loan was at 50,000 Rand. I'm going to write it in here for you just to explain so you can see what happens. There's my 50,000 Rand. The interest for that month was 625. When my loan changed to 40,000 Rand, because I repaid a portion of the loan, my interest now becomes 500 Rand. And the same would be applicable to September because the loan was still 40,000 Rand at that point. So in other words, a change in my mortgage loan, because I repaid, obviously the interest will decrease because my loan is no longer 50,000, but my loan is now 400,000. So once again, read the question, see when the repayment takes place, and also then base your new calculation on your new loan figure. Okay. The next one that we have here is the depreciation, right? You are told that your depreciation for the year, annual depreciation, was 12,600, right? Then depreciation will remain fixed for July and August. That means July and August is 50,000 Rand. The depreciation for July and August will be fixed, meaning no change. It was the 12,600, which was the annual figure, right? On the 1st of September, the firm will purchase equipment for 48,000 Rand. It means new equipment will be purchased. When will this happen? This will happen on the 1st of September. Okay, right. This means, therefore, that your depreciation remains constant at 10% per annum on cost. Watch my calculation. Step number 1. Depreciation is fixed for July and August, right? So immediately what I say, take my calculator and say 12,600. 12,600 divide by 12 will give you a figure of 1050. That is the average per month. That is your average per month. 12,600 divided by 12. Okay, now what happens? In August, additional equipment is bought, right? Once again, I say 48,000 Rand, the value of the new equipment, times the 10%, which is your rate of depreciation, will give you, let's do that calculation there. So we have 48,000 was the new equipment that we purchased, times the rate of depreciation was 10%, and that gives me a figure of 4,800 for the year, right? Divide that by 12 per month, works out to 400. Okay, so now, what do we notice? That on the new equipment, there's additional depreciation of 400 Rand. This means, therefore, let's look at this here. July, it was constant. There was no change in my depreciation, therefore 1050. August, no change in my depreciation, 1050. However, because we purchased the new equipment, and as a result of that purchase now, watch what will happen. Here you can clearly see that on the 1st of September is when we bought the new equipment for 48,000 Rand, which resulted in an increase of my depreciation of how much? Let's look at the calculation again. Remember, the new equipment's depreciation was the 400 Rand. Therefore, you add the 400 Rand and you get your new depreciation figure of 1,450. So clearly, guys, it's important that you see how this will impact on your projected income statement. These are just examples of calculations that we are doing with you. Okay, let us summarize. 1, the projected income statement is a plan that will predict the amount of profit a business will generate. It's a plan. It's projected. It's forecasted. 2, the projected income statement takes into effect incomes and expenses. And 3, when you're using these figures from the previous year's income statement, divide the amounts by 12 to find out what was the amount per month. Important. Very, very important. So therefore, what are we saying? When you are working with a question on the projected income statement, look at the income statement that is provided for you. If it's annual, divide by 12. If it's biannual, for half the year, divide by 6. Clearly you can see it will change the figures completely if you divide by the incorrect number. Okay guys, that's it for today's lesson. We focused today's lesson on the projected income statement. So what are you expected to do? Work on examples, work on question papers, work on activities, and make sure that you fully understand the projected income statement. From me, Ashraf Patel, and the team, until the next time, be good. Bye-bye.